Hi, good morning. Thanks for joining us for our weekly Monday research morning call. Today's agenda will have Amazon.com, Capital Corp, BRC Asia, SGX, Escort Residence Trust, StarHub, and Oxley Holdings, which is a Philip on the ground. And together we have the FANG-M Monthly and the Singapore BankLink Monthly, and then we end with the Singapore Weekly, week 7. So we move on first to Amazon. Amazon reported their fourth quarter 21 results last week. And so the title is Normalizing Sales Growth After a Pandemic-Induced Spike in E-commerce Sales in 2020. So results were in line with revenue and PATMI at 99% and 102% of our FY21 forecast respectively. So if we move over to the positives, there were some huge one-off gains that Amazon had for the quarter. The first one is a pre-tax valuation gain of 11.8 billion from the IPO of Rivian Automotive Inc., which is one of Amazon's investments into this company. So it IPO'd last year in November, in which they enjoyed a huge valuation gain. The second one-off is a 17% increase for Prime membership in the US. So with 149 million Amazon Prime members in the US, that translates to about $3 billion extra for Amazon's profit before tax for FY22. So these are the two huge one-off gains that likely led to the 15% jump in share price after the results. For in the operations side, for the positives, the fourth quarter margins were better than expected. So 2.5%, beating guidance of 2.3% and the estimates of 1.8%. This was due to less than expected hiring during the holiday season. So they only hired about 140,000 versus the guidance of 150,000. For AWS, which is Amazon's cloud business, Amazon Web Services, this accelerated while everyone expected a deceleration. So the revenues from this segment grew at 40% year on year. So versus consensus of 35% and our forecast of 33%. AWS is actually very important because it's a key growth driver for Amazon, contributing 75% of the full year operating income. For the negatives wise, e-commerce growth is moderating. So this is the negative for Amazon. It grew slower than expected. It grew at 4% year on year, slower than the consensus estimates of 5%. And Amazon's fulfillment network is no longer running at 100% capacity, which it did back in 2020 and the early part of 2021. So the end of 2021 is no longer running at 100% capacity. But Amazon still needs to pay for unused capacity in the fixed costs. So this led to a $1 billion negative impact with regards to lower cost leverage because of the lower capacity usage. So moving forward for the outlook, the sales guidance was weaker than expected, mostly because the e-commerce growth is normalizing after the pandemic surge. And Amazon is still investing, so CapEx is expected to remain elevated in this year as it ramps up their Amazon Web Services infrastructure, which is like the data centers and as well as the transportation capacity for the e-commerce business. So in light of the weaker sales guidance, we cut our revenue by 3% and reduced our operating margins from 8 to 6% due to still elevated wages and fulfillment costs, which lowers our FY22 PATMI by 31%. But this only lowers our target price slightly from 4157 to 4079. Overall, we're still positive on Amazon. 2022 will have easier comparables compared to 2020. So if in 2021, which is last year, the revenue grew by 22%, and compared to 2020, which revenue grew by 38%. So in FY22, Amazon will have easier comparables to beat this year as compared to last year when it compares to 2020. We think margins, the swing factor is margins. So the guidance for margins is 2.7 to 5.1%. And we think margins can jump from the eventual easing of fulfillment and labor costs. Amazon is expecting for fulfillment and labor costs to ease next quarter as well, as the supply constraints ease. Okay, we'll move on over now to the FANG-M monthly. FANG-M stands for Facebook, Apple, Amazon, Netflix, Google, and Microsoft. So we'll just go through their performance for the month of January 2022, which is titled Painful January. Because it was a painful month for them, the FANGs underperformed the S&P 500. So the FANGs, if you look at the chart, it's mostly all down for the month of January. The FANGs declined by 7.7% compared to the S&P, which fell only 5.9%, sorry, in January. The laggards were Amazon and Netflix. So these two stocks are the ones that are actually normalizing after the pandemic surge. So Amazon was there was pressure on Amazon from likely from inflationary pressures as the wages are elevated. For Netflix, they were experiencing higher competition and normalizing growth after the pandemic. Overall, we are still overweight on the FANGs. Tailwinds are still intact, but albeit more selectively. Okay, so we will just review the news for January and also their results. For Apple, the first quarter results was a clean beat, so they just beat across the board for volumes and margins. So iPhone volumes and the prices were higher than expected, and they had record gross margins, and all this despite the supply chain issues. The outlook for Apple is also good. They guided for a record second quarter 2022 as the supply chain constraints ease. And just to note that according to some reports, 2022 is Apple's anticipated widest array of product launches ever in their history. So this, as the supply chain constraints ease, it sets up a good backdrop for this a record number of launches that they have for this year. But there was slight negative news with regards to their augmented and virtual reality headset, which was anticipated to launch in June this year. So due to development challenges, they will most likely push it into 2023 instead. Okay, for Amazon wise, we went through the results just now. There was a slight good news for Amazon for their labor situation. Amazon will be shortening their paid leave for COVID-19 positive workers down from 2 weeks down to 1 week. So this will help to narrow their labor and productivity issues more likely in the next recent quarter. So we hope to see better costs, lower costs in the next quarters. For Microsoft, in summary, second quarter 2022, they're basically firing on all cylinders. So all their businesses margins are up across the board. So for Azure, which is Microsoft's cloud business, similar to AWS for Amazon. So Azure is Microsoft cloud business. It grew faster than expected as well, and it grew by 46% year-on-year compared to consensus of 44%. So this is also important for Microsoft because it's a key growth driver. 45% of Microsoft's gross profit growth is from Azure. Margins were up from premium licenses for cybersecurity, more scale in cloud, and more growth in higher margin businesses. So across the board, it did really well. And the results guidance for next quarter is also strong. They expect the momentum to continue. So we think that Microsoft, in addition to Apple, these two stocks are the FANGs that are both seeing higher margins despite the rising cost pressures from inflation. So we think these two stocks act as good inflation hedges as inflation spikes up in the near term. Okay, I'll pass my time over to Jonathan.
Thanks, Tim, and good morning, everyone. So I'll cover Meta, Netflix, and Alphabet. So for Meta Platforms, fourth quarter results and full year results were actually in line with our expectations. They actually grew. Year-on-year growth was actually pretty good, 20% year-on-year growth for the quarter and 37% year-on-year growth overall for the year. This was mainly led by a 9% year-on-year increase in user growth and increases in ad prices and ad impressions. So other than their results, guidance and the earnings calls was quite negative, which was one of the reasons why the stock price tanked more than 25%. There was still a lot of concerns surrounding Apple's iOS privacy changes, which happened around the second and third quarter of last year. And so actually on Meta's earnings calls, they actually did mention that these privacy changes have been reducing the effectiveness of their targeted ad campaigns, and also making it a lot more difficult to track the performance of these campaigns. And as a result, a lot of advertisers have actually begun to reallocate some budget away from Meta and towards their competitors like Google and Amazon. Meta also talked quite a bit about increasing competition from TikTok, which has affected their user growth. So quarter-to-quarter growth was only 0.3%, which is, I guess, pretty much flat. And actually for Facebook itself, quarter-on-quarter growth was negative for the first time ever, which is a little bit concerning, at least to a lot of investors, it's very concerning. And as a result, Meta has actually begun transitioning towards more short-form videos, or rather a short-form video format to compete with TikTok and all the newer social media companies. And this is mainly to target a lot of the younger audiences out there. And this is actually going to lead to an increase in expenditure led by investments in tech talent and IT infrastructure. So guidance for the first quarter of this year and for full year was quite poor, with only a 3 to 11% year-on-year revenue growth for this quarter. Total expenditure for the year is expected to rise at least 26%, with capex increasing at least 56%. And this is obviously going to be due to the increasing expenditure, like I mentioned earlier. And as a result, we expect margins to decrease significantly for the full year FY22. Moving on to Netflix, revenue growth was quite strong, and their earnings actually outperformed consensus. So for the fourth quarter, the revenue growth was 16%, and for full year, it was 19% year-on-year. And this was largely due to an increase in users and subscription prices across the board in a majority of their regions. Earnings grew 85%, and this was led by increasing margins. The one on Netflix, which also caused their stock price to tank quite significantly, was the guidance. They had very weak first quarter guidance for user additions, guiding to only 2.5 million paid net additions in the first quarter compared to the first quarter of last year. Sorry, compared to 4 million in the first quarter of last year. Mentioning several growth headwinds like a back-end release schedule and macroeconomic strains in Latin America. But this also could be due to the fact that a lot of people as the world is reopening from COVID-19, less and less people are staying at home and less and less people are spending more time at home. So which could provide a little bit of headwinds for user acquisition. Moving on to Alphabet. Alphabet in general was very positive. Revenue growth was really strong. For the quarter, it was 32% year-on-year and 41% year-on-year for the full year FY21, compared to their 5-year CAGR of only 23%. So like always, ad revenue was the main driver with 33% year-on-year increase. So for Alphabet, cloud services continues to be their fastest growing segment, with a 45% year-on-year growth for the quarter and 47% year-on-year growth for the full year FY2021, which is quite similar to Microsoft Azure as well. So some of the positives, or rather the main positive for their cloud services is that they have quite a significant backlog. So they've got a $51 billion order backlog for its services, which basically sums up the kind of demand that their cloud services are seeing right now. As a result, or rather, because of this, they're going to continue to spend increase investments in their IT infrastructure to make sure that they have enough supply to meet the demand for their services. Next slide, please. So overall, we remain overweight on the FANG with secular tailwinds intact. We raised our target prices for Apple, Google, and then Microsoft by 14%, 3%, and 1% respectively after their earnings beats. And we also upgrade our recommendation for Google to a buy. We lowered Amazon's target price by 2% on slowing growth outlook, but remain positive on catalysts from easing labor and fulfillment costs. So we reduced Facebook's, or rather Meta's and Netflix's target price by 26% and 7% respectively on lower margins and user growth. However, we upgrade Netflix to a buy after its significant share price correction, which happened after their earnings came out. So that's all for our Fang M Monthly. I'll pass my time now on to Terence for Keppel Corp. Thank you.
Thanks, Jonathan. And good morning, everyone. Next, we published a report on Keppel Corp last week, talking about the arbitration proceedings against SPH. So, Keppel Corp has commenced arbitration proceedings against SPH. In our next slide. This after it received termination notice from SPH to terminate its implementation agreement. SPH said there was two reasons for doing so. Number one, the custodian offer was more superior than Keppel. Secondly, the SIC, Securities Industry Council, had no objection to the termination. Our view of this is the arbitration proceedings will have a muted effect on Keppel, even though we saw some weakness in their share price after the commencement of the arbitration proceedings, but we don't see any major financial impact on them because it's just a arbitration against a disagreement that they have. But the arbitration will be an overhang on the stock until a decision from the arbitrator has been made. And this will take a few months. Separately, Keppel O&M also announced that it has been awarded total contracts worth around $250 million from repeat customers. So this Keppel O&M contract win will further, in our view, bolster the group's bid to realize the divestment from their O&M business. Because none of this will have any significant impact to our financials, so there is no change to our financials, recommendation, and target price for Keppel. We maintain a buy recommendation with a target price of $7.07. So that's all for Keppel. The next stock is BRC Asia, which reported a voluntary disclosure of their first quarter 22 results. Next slide. So first quarter 22 net profit actually exceeded our expectations. This was a surprise because their first quarter 22 results is seasonally weaker. The beat came from higher volumes delivered. So if you look at the table here on your left hand side, you can see we compared the first quarter 22 results with their fourth quarter 2021 results. So we look at it from a quarter on quarter basis. So revenue and gross profit rose 6.5%. In the GP rose in line with revenue growth. We believe the increase came from higher volumes moved. Net profit margin also increased 3.7% because of the stabler gross profit margin and the stable credit situation. Order book in the first quarter rose slightly from $1.2 billion to $1.3 billion. The first quarter of financial year 2022 also saw a significant deleveraging of the group's balance sheet as it saw $132 million in free cash flow during the period. The bulk of the free cash flow was used to repay debt. So if you look at the table here on your left hand side, the last row, if you look at the net gearing, you can see net gearing more than half to 0.5 times in first quarter of 2022. So in terms of the positives in our next slide, like we said, first quarter is the first two quarters of the year is traditionally weaker for BRC Asia. So for them to show a 30% increase in net profit, this was a positive surprise for us. And it really shows the construction recovery continuing into the first quarter of financial year 22. We also see the significant deleveraging of the balance sheet as positive and allaying some of the fears of the market for this very significant gearing. But we do expect, even though you see gearing falling to 0.5 times in first quarter, we still expect gearing to remain elevated for the rest of financial year 2022, mainly because the most of their debt are actually trade financing used to finance the purchase of inventory. So with steel prices rebounding, and also especially in the last 2 weeks, we believe that they will still need to borrow a substantial amount to finance the purchase of this steel. So leverage will likely remain elevated, but it will normalize as they fulfill more of the contracts as well. In terms of outlook, the outlook for financial year 2022 remains strong, with the Building and Construction Authority (BCA) upgrading their 2022 forecast by 3.5%. We'll talk more about this later. Steel rebar demand is also forecasted to grow 22% to 1 to 1.2 million tons, in tandem with the overall construction recovery. So in our last slide on BRC Asia, in terms of the outlook, we believe the government will continue to ease border restrictions to aid the recovery in the construction sector. If you look at the first half 21 foreign worker outflow, this was about 32,600. So we have the full year 2021 foreign worker outflow updated when they release it, but you can see it's quite significant. So this foreign worker outflow really hampers the recovery in the industry. Sorry. So if they further ease border restrictions, then we believe that the construction sector can actually move more, the recovery can actually take place more quickly. In line with this, the BCA has also upgraded the forecast for construction demand. You can see the construction demand forecast has actually tightened from the $25 billion to $32 billion range to $27 to $32 billion. Based on the latest forecast by them. So we maintain our buy recommendation with an unchanged target price of $1.84. Our valuation is still based on 11 times FY22 PE, 15% discount to its 10-year historical average PE, as we wait for further signs of a firmer recovery in the construction sector. So that's all from me on BRC. I'll hand over the time to Glenn on SGX.
Thanks, Terence. Glenn is absent with apology, so let me just try and summarize for him SGX results. So regarding the results, you can see that revenue was flat year on year. This was despite having acquisition. So revenue was actually pretty sluggish. So the first point, the new businesses, which the new acquisitions they make from like BidFX to penetrate the currency market. The other underlying business was really reasonably stable. The third point is the FTSE China A50 contract showed growth. The reason why we're bringing it up is because Hong Kong has released the MSCI China futures contracts. So we will have to monitor this closely so that the Hong Kong MSCI doesn't take market share from FTSE, which is a SGX product. And so far it hasn't. The negative is that SGX, probably not everyone may know, they're actually dependent a lot on interest rates too, almost to a certain level to the banks, because what happens is that when all the future exchange partners, they actually have to park in collateral, with the SGX, when if volume goes up or goes down. So because of the lower interest rates, the yields drag down the equity, their treasury income. In terms of the outlook, so what SGX is trying to do, I guess not much luck in doing IPOs, but at least they are trying to build up their derivatives portfolio, especially on the currency markets. That's why they're investing a bit more in the medium term for acquisitions. The main driver for earnings, we think, will be rising interest rates. If we assume 100 basis points, which is quite consistent since the Fed is expecting 100 rate hikes this year at a minimum, it could actually move the SGX earnings by maybe just a rough estimate, maybe 10 to 15% or more in terms of the earnings improvement just on higher interest rates. But the management did say that don't expect anything now, but any improvement in treasury yields will only probably come in the falling FY23 results. So in the meantime, it will just depend on volumes, which we will show you later that January wasn't very strong anyway. Next slide. So this is the Singapore Banking Monthly. So for this, I think that in a nutshell, although the interest rates in the US has moved quite significantly or are expected to move, we didn't really see much movement in terms of the Singapore SIBOR or SOR rates. Next slide. Okay, this is just an illustration of Hong Kong and Malaysia. We show this because not all the banks have exposure to Hong Kong and Malaysia, and we're just monitoring to see if there's any sudden spike or just moving sideways, just to gauge the conditions in both countries. Next slide. So this is more the SGX slide. So you can see that for January, despite all the volatility in the US, it didn't translate to higher volumes here in Singapore. The first one you can see SDAV, which is basically stock market volumes, is actually down 20%. And the bottom is the some of the equity futures. They have a lot of futures, but we look at the main ones. You can see that even that also it's only up about 2%, so not much of a movement. So the volatility in the US didn't really bring up volumes for the SGX. It was virtually flat. So far, second half probably look like another flattish half for SGX. Next slide. I think that's the. Sorry, this is just an illustration of the price to book. For us, we favor more OCBC purely on the valuations, as you can see from the yellow line. And secondly, because of their high capital adequacy ratio, they probably have the highest among the three banks, about 15%. So we think they could actually surprise on the dividends. I mean, the results come out, I think, next week. The next slide. Okay, I hand it over to Natalie. Thanks.
Hi, good morning, everyone. Thank you, Paul. So I'll be talking about Ascott Residence Trust FY21 results. Next slide, please. Okay. So starting off with the table on the left-hand side, gross revenue grew year on year. It grew by 29.7%. It grew by 6.6% for the full year. This was due to higher revenue from its existing portfolio, as well as contributions from its acquisition of 7 student accommodation assets in the USA, as well as 3 rental housing properties in Japan. Of course, FY21 revenue was also partially offset by the loss of revenue from divestment of 6 assets over FY20 to 21. Overall, DPU grew by about 40% from 303 cents to 4.32 cents. And this DPU of 4.32 cents was in line with our forecast, coming in at 99%. Moving on to the positives, this is the fourth quarter was a sixth quarter of RevPAR recovery, with gross revenue, FY21 gross revenue up by about 15%. Okay, so the better performing geographies were US, UK, as well as Australia. So for US, the recovery of revenue of gross profit was partially due to the acquisition of the student accommodation assets, but it went from a negative, a loss in the previous year, and it's strong to profitability of about 12 million in terms of gross profit. Also for the UK and the Europe side, they actually benefited from stronger demand during the summer months as there was easing, and so therefore domestic and international travel sort of picked up. In France, this asset actually managed to hit about occupancies of 80% during the summer months. And also, of course, in Australia, there was a 54% recovery in gross profit. Okay. In terms of leases, so Ascott has 3 different kinds of leases. The stable leases are the master leases, as well as the management contracts under minimum guaranteed income. And revenue for these 2 lease types were relatively stable. They were down slightly by about 2 to 5%. This was due to some reclassification of master leases or MCMGI to more variable management contracts, as well as a closure of 2 WBF properties in Japan. Yeah. So overall, for the revenue, the stable leases were still relatively stable, and we saw the recovery more strongly in the management contracts, which reflected a 48% growth in gross profit. Okay. The second positive is the active portfolio reconstitution into long stay assets that will help show up stable revenues. So over FY21 and 22, Ascott divested about 580 million in assets at exit yields of 2%, and they've reinvested 785 million into the long stay segment in FY21 at higher EBITDA yields of 5%. So with this move, they have successfully replaced all the divested income, and we should expect some earnings growth. Okay, in terms of negatives, recovery is relatively fragile, and we saw in FY21 that the performance of properties was impacted by the tightening and easing of measures in respective countries, and so the travel bubbles were delayed twice, in FY21 due to the emergence of the Delta and Omicron variants, and that resulted in softer demand in certain months. So overall, moving forward, we may still expect some knee-jerk effects from new severe variants that could trigger some imposition of restrictions. In terms of outlook, there were two assets that turned operational in November of 2021. One of them was Life One North, which was the asset that was under development in Singapore, the One North area. It's a co-living asset. And in the first phase of its opening, there was about 140 rooms out of 324 rooms launched. And Ascott managed to achieve a high occupancy of 96% for these 140 rooms. And the bookings for this property ranged between 1 to 6 months, and they benefited from bookings from the companies located in the One North area, as well as the educational institutions like INSEAD located in the vicinity. Similarly, Voco Times Square. Voco is the brand, is an IHG brand, so it's a bit of an upscale / lifestyle kind of brand, and it reopened in November. And this is very fortunate because in the US, especially the New York side, is actually experiencing a pickup in demand, leisure demand. Yeah. So the timing is really good. Okay, the second positive would be the growth of the stable earnings, which is the long stay segment. So Ascott is raising their medium-term target for the long stay segment from 15 to 20% up to 25 to 30%. Yeah. So currently, the long stay assets are about 16% of AUM. So they are raising it to 25 to 30%, and we feel that this base of stable earnings is actually very highly valued in a hospitality counter. Yeah. So just a little bit about these extended stay kind of assets. For example, your student accommodation and your rental housing properties, they have enjoyed very high occupancies above 95% throughout the pandemic 2020 to 2021 period. And the average length of stays at these assets range between 1 to 2 years, with bookings secured several months ahead. Yeah. So we think that this will help to provide income visibility and stability to mitigate the more volatile corporate and leisure travel related earnings. Overall, we maintain our accumulate call, and we raise our target price slightly from $1.19 to $1.23. So our FY22 to 25 DPUs have been lowered slightly by about 5 to 11% as we push back recovery from FY23 to FY24. And our target price is increased basically because we rolled forward our estimates. Yeah. Okay. So that's all for me. I'll now hand the time over to Paul.
Thanks, Natalie. So we move on to StarHub's fourth quarter December results. As the title suggests, the results was actually above expectations, but they're making an investment phase right now. So the next, especially this year, the earnings is going to be subdued because they're going to invest quite a lot in CapEx and also in OpEx, and it's going to drag FY22 earnings. And that's why maybe you saw this morning the share price is down. But anyway, let's move on to the next slide. So in terms of the results, the fourth quarter, the revenue was within our expectations, but the EBITDA or profit actually beat our expectations quite significantly. And the reason is, as per the positives, they managed to cut expenses quite dramatically in the fourth quarter. So where are they cutting the costs? I think this is a transformation they did maybe 3 years ago. where they actually realigned the pay TV. So they cut a lot of content costs because in the past, the content costs, I'm guessing like HBO, even though there are very few subscribers, you still have to pay a fixed amount. So these are some of the types of content costs they cut, the programming, and they also digitalize a lot of the processes. So they try and remove the middleman, shut down some stores so that if anyone wants to subscribe to a new plan, you just go direct to them. The other positive was free cash flow was 485 million. So this is the highest since listing, on record. And they also paid dividends full year of 6.4 cents, which is better than our expectations of 5 cents and their guidance of at least 5 cents. So right now they're giving probably a yield of 4%. The negative, which is a bit more of a structural thing, is that the revenue continues to be weak. So the revenue you can see from the table is down 5. But because sometimes revenue includes equipment, so to have a cleaner number, because equipment depends, I know you subsidize an Apple handphone, then your equipment sales will rise. So normally we look at service revenue to have a more normalized sense of their telco revenue. So you can see that is still decline, and you can see some of it is from network and also mobile. So the roaming continues to be a drag for them. The other negative was the FY21, the cybersecurity, which is supposed to be their highest growth driver. The revenue was up 22, but the earnings was down 7%. In part, there was some inventory write-off, but I mean it was a bit disappointing in terms of the cybersecurity profitability, because this segment is still on the investment mode and they still need to hire a lot of IT professionals. So in terms of the outlook, before I go on the outlook, just to give you some context, over the last 3 years, the revenue for StarHub, excluding the acquisitions and so forth, was actually down 500 million. So it's a huge number. But the EBITDA was only down about 50 million. So they took out a lot of costs over the last 3 years, especially staff costs and so forth. I think it's in my report. But so right now, with all this cost restructuring almost completed, so they need to now think about how to grow the business and cannot keep on cutting costs. So they're going to embark on this strategy called DARE+, which is a 22 to FY26 roadmap. So as a result, they're going to invest quite a bit, especially on technology and IT. So that's why their margins, which was 30%, you can see from the table, it was 30% gross service margins. Now they're going to drop it to 20. So it's quite a big hit. It's about maybe 80, 100 million kind of hit to the earnings. And another curious thing is they also mentioned electricity expense, which is probably the first time I hear a corporate say electricity is an issue. So that is also going to shave a few percentage points off their margins. They're also going to ramp up CapEx. So of course, the natural question is, after doing all this, so where's the revenue opportunity? They didn't really specify, but they just hinted for consumer, they will tap more on gaming content and so forth. And for enterprise, they'll work on some 5G solutions. So for that part, they weren't willing to share what kind of new growth opportunities they're going to give. But as a result of this, we had to cut our EBITDA by 22%. We actually maintain our neutral recommendation because we raised our valuation metric, because some of the peer mobile operators, all the valuations actually climb back up. So we're just trying to normalize that. So that's why we still have a neutral. And we also move a bit of our ARPU because of roaming. So in conclusion, for this stock, it's probably after this decline, it's probably just going to move sideways until we get some borders reopening. Then we can get the roaming revenue back, which is 15-20% of revenue, and it's easily 30% of profit. So you can get this immediate jump in profit if no roaming normalizes. But again, until then, I think this stock will probably be moving sideways until the market kind of re-rates it with the increase in roaming revenue. Okay, next slide. So move on to our usual updates on Singapore. For the macro, we had some tourism numbers. It was much better than last year, 57 versus 23, but compared to pre-pandemic, it's still far away. Pre-pandemic, we were 1.68 million per month. Now we are 50,000. So it means it's a 97% drop. If you compare to pre-pandemic, we are still only 3% of pre-pandemic levels. So I guess no one's coming here. The other part is just on real traffic. This one is more for comfort. A very modest improvement, I guess, because of festive period and so forth. So we expected a bit more because of the work from workers coming back to office, but I guess it's not this month so far. Construction was still very positive, although for the month it's only up 4%. But for the year, like Terence kind of highlighted, the construction is up almost 40% year on year in terms of construction work awarded. And it's just only 11% below pre-pandemic, despite all the shortage of foreign workers. In the US, the big number was CPI or inflation. So that was 7.5. Actually, it was just modestly above estimates, but the market took it negatively. It's still the highest inflation rate since 40 years, since February 1982. I guess some of the worries is that even services is also climbing up to like 30-year highs. So the worry is that inflation in the US is spreading not just from goods, which we all know, like cars and so forth, but it's now moving on even to services. And right now the debate is whether the Fed will, in the March 16 meeting, they're going to raise 50 basis points. In terms of our tactical views, we are optimistic on the reopening trade. The reason is that I think there was some commentary by the minister that so far the Omicron wave in Singapore is within or maybe even below expectations in terms of the severity and of cases, to those in oxygen and in ICU. And the other positive is that I guess our toolkit to cope with the pandemic has widened, because now we have antiviral drugs coming into Singapore. And paradoxically, I guess with more infections, it also means that the immunity is also spreading. So we think there's chance that the lockdowns may not be in the near term, but hopefully, there's better opportunity now that the reopening will progress further. So some of these stocks that can benefit, with Ascott, Comfort, Telcos, and even Genting. For the week, so today is the DBS results. Then we had UOB coming up on the 16th. Okay, I think I'm on next slide. This is our usual look at the global COVID cases. The good news is that the blue line, so cases are actually starting to taper off quite sharply globally, even in the US and Europe. So after this big spike in cases, the good news is that the global cases are starting to trend downwards. Next slide. For Singapore, I think it's just the hospitalization, which is the red line. It's still below the peak, so hopefully it doesn't cross it. Then we have to raise some concerns. But right now, it's still like 30% below the peak levels. Next slide. If you look, this is just a very gloomy chart, and if you look on the left, so this is the amount of monthly tourist arrivals into Singapore. I think, as we mentioned, it's only like 3% of pre-pandemic levels. The right is just the illustration of transit, the number of passengers. So this is going to be an important driver for comfort. I mean, hopefully the volumes can come back on. Next slide. Okay, this is construction. So you can see on the left, the blue chart, the almost V-shaped in terms of the construction awarded. So these are contracts awarded by the public and private sector. The red line is just the billings. So for people to start to do work, there's always a bit of lag, obviously. The chart on the right is just the construction contracts awarded on a yearly scale. So you can see that pre-pandemic 2019, the amount awarded was a record 33 billion. It collapsed to 21 in 2020. Then it recovered very sharply to 30 billion. Then the BCA has guided, I'm just taking the average, it's about 25 to 32, but what it does mean is that construction activity will be very elevated the next 5 years. If you compare to the pre-pandemic, even 2014, 2016, we're talking about maybe 20 plus billion. So right now it's about the high 20s compared to maybe the mid 20s in terms of construction activity. So the construction sector looks kind of resilient, at least the next couple of years, because the BCA kind of guided there's going to be a lot of contracts being awarded, not only just for this year, but the next 3 to 4 years or 5 years. Next slide. Okay, this chart is just to give you an illustration of the spike in inflation in the US. So the red line is the inflation rate. So the last time we had such a high inflation rate was in February 82. And if you look at the blue line, which is the interest rates or 10-year treasuries in the US, it is now, at that time in 1982 was 14%. Right now, it's of course 1.8. So the thing is, there's either a lot of interest rates has to catch up a lot, or the market must be pricing in something else. So again, we're not sure. I mean, the market could be pricing in some, I don't know, some deflationary event, either from Ukraine or even China. That's why they're not willing to bid up bond prices, or they think that inflation is just tapering. I mean, I don't have the answer. I'm just showing you there must be a reason why. I was surprised. I mean, bond yields should have been much higher despite the record levels of inflation. Next slide. Okay, this is just my last macro slide. This is just to show you, if you do the last few times when there's a hiking cycle by the Federal Reserve. So this means these are a visual count. I mean, this is not like ultra precise, but whenever the Federal Reserve, let's say, raised rates in 1961, then number 2, number 3, out of the trough times the Federal Reserve started to raise rates, you actually resulted in recessions. So that I guess that's what the market is a bit more worried that if they raise, whether they raise it so much until you trigger some inflation. Again, this is just for illustration. Next slide. Okay, as usual, we have our Philip on the ground. So Oxley had a first half results briefing. So let me just run through it, hopefully quite quickly. So Oxley is a property developer mainly in Singapore and especially in London and Ireland, UK and Ireland. So the results wasn't good. The results was down 46% to 23 million. But if you strip up some of these one-offs, they could actually be loss-making, because in their results, they included 29 million of gains, which is like derivative gains and also deposits forfeited from residents or property buyers. I'm not sure which project they didn't say. So that's one. The other problem we have is that they make 82 million in profits, but the problem is 60 million. So you can do the maths, probably like 70-80% of the profits just goes away to pay the bankers, which is interest rates. So of course, it's due to their high gearing. Of course, the other one is that they included in the results is a 10 million loss. If you look historically, actually their NTA actually dropped the last 5 years, which is strange. I mean, most companies NTA actually rise. So I think the issue is that they make a lot of losses in a lot of these investments that they make. The losses from this investment they make in Galiad, 100 million, then receivables, so they lost 100 million. Then the Pindan Group, which is another subsidiary, some construction company in Ireland, I think, they acquired that also. They had to liquidate it, and then they had to pay a dividend. So maybe that's the reason why the share price hasn't done well. The NTA basically has shrunk despite, I mean, in 5 years, they didn't even grow anything, so it just shrunk. I guess of most interest would be on their comments on the cooling measures. So let me just repeat what they say. I mean, just to share with everyone. So in terms of the recent cooling measures, what they said was that it probably, as expected, will take time for buyers to get used to the impact, but they still see first-time buyers and upgraders supporting demand. And the mass market price is now like 2,000 is the new mass market price. So they don't think prices will come down. For them, what they're going to do is they're going to wait and see how demand is before they look to buy more land, because they're actually already very busy. If you switch to the table on the right, you can see that Singapore, they got almost 1.54 billion of projects already sold but yet to be built as revenue. So in terms of the outlook, they got 1.8 billion to be recognized, actually mainly off from Singapore. If you look at the table on the top, 1.821. So that's the amount of revenue that they can recognize in a year. So this is like roughly 1.5, almost 2 years of revenue, because they usually generate about 1 billion in revenue. The main one, the next big project for them will be in Ireland, the Connolly Station, which is 1.4 billion. I think the one that I won't say is an issue, but something to watch is the Malaysia, because they have this only 20% sold, this Oxley Tower. So the good thing is it is unsold, 717, and the bad thing is if you cannot sell it, then it becomes your inventory and you're stuck with it. So that's the other project that they have to monitor, which is the Malaysian project in KLCC. Okay, anyway, that's the briefing. I mean, we don't have a call, but it's just for everyone's reference, because some may not be able to have the chance to attend. Next slide. Okay, so this is my last slide. Nothing much. This is for you all just for reference. These are some of the results that's coming up this week and next week. And in yellow will be those that we cover. We'll try to give you guys some feel on the ground for those that we attend, and at least those who don't have a chance to attend, at least you can get an update of what's going on. I think with that, we can move on to question and answer.
Okay, I'll take some questions for Facebook and FangM. We've got a question here. Please advise on Facebook. Still can buy now that its price will go up in future time. Thanks. So I guess for Facebook, if you look at it, it's been going downhill pretty rapidly. It's pretty much back to its pre-pandemic levels of about 220. But overall, business-wise, even though we do see some pressures for revenue growth and user growth and all that, we do think that it's still a good price to buy at right now, given that it's I guess about 40% off its 40+% off its highs, and the valuation is looking quite attractive right now. Next question. Hi, among all the FANGs, which two are your least preferred to buy? Even though all of them are showing buy, in the past, your end highlighted Meta as the least preferred before it tanked. So I guess this is going to sound a bit contradictory, but our least preferred to buy would be Meta as well as Netflix, and this is mainly because of growth pressures and some form of normalcy or return to normalcy for Netflix. Margins also are expected to contract a little bit, which is a bit, I guess, surprising especially for tech companies, for ad companies. But yeah, the only reason why we say those two are the least preferred are because the other four are quite, I get quite good relative to the rest of them, to these two FANG stocks like Apple, Amazon, Microsoft, and Google. And the outlook for them for this year, even with the inflationary pressures and rate hikes are not as much. Next question is, do you expect the softening of the share price of FANGM to continue until perhaps there is more clarity with the amount and number of rate hikes? So we don't actually expect the FANGM prices to continue going downhill. I think the market has largely priced in what are the expectations of the rate hikes, the interest rate hikes. But for some context, the interest rate hikes actually shouldn't really impact at least half of the FANGM companies because they don't really borrow money. So the cost of borrowing to them doesn't increase in cost of borrowing to them doesn't really do much because maybe, yeah, I mean, compared to other companies that are so rich in cash that they don't really need to borrow money. So we do think that markets already priced a lot of the interest rate hikes, priced it in. So we don't expect these stocks to continue downwards too much. I think that's all the questions I have for FANGM. Oh, sorry. Okay, I have this other one. Please, is it better to buy Microsoft, Meta, or Google? I think for right now, you would, out of the three, you would probably put your money into Google. They seem to be increasing their dominance in the digital advertising market. Their revenue is growing really strong. They're focusing a lot on cloud services, and they've got a really big, a really large order backlog for their cloud services. So I would, out of the three, I would definitely prefer Google moving forward. All right. I think that's all for me. Thank you.
Yeah, I'll just take the rest of the questions first. Is there any update on Pan United, which was previously covered in a report on 6 August 2021? Is it still a buy with TP of 44 cents? So yes, the 6 August report was a coverage of their first half 21 results. And because they already moved to half yearly reporting, so there's been no new updates since 6 August, but they are going to report results next week. So when they full year 21 results next week, or second half 21. So when they report results next week on the 23rd, we will do an update on the report. Yeah, then we'll present. We keep you updated then. Thanks for the question. Next question, Terence, any counters will benefit from the spillover effects from BRC Asia good results? Thanks. Not for Singapore, in Singapore, but usually we don't see any counters benefiting from this BRC Asia good result, because BRC Asia is like a second derivative. You need construction demand to first come, and then they give the contracts to BRC Asia, and then they fulfill. So it's a derivative of construction demand in the industry for this. So no, the short answer is no. Yeah, I think that's all for me. I will hand over the time to the rest.
Okay, thanks. Let me just try to run through. Sorry, just as a reminder, we don't have a technical analyst yet, so we're looking. Hopefully, we get the person soon. Then, so as a result, that's why we can't really help out on some of the technical questions. So apologize for that. So give us some time. Probably, maybe hopefully 2-3 weeks time, then we can find someone that can kind of address all the technical questions. Let me just run through. Please comment on what is going on with Wilmar, and also that what's the target price cutlass. Any views on this counter? Yeah, we don't particularly cover, but as we kind of highlighted again, the only thing we can say of palm oil is that they lose a lot. They lost a lot of tractions because of all these ESG concerns. So even though, sorry, I keep repeating this, so apologies those who have heard it before, but even though palm oil price hit record levels, even Golden Agri, some of these share price never gone back to their 40% level highs. So I think ESG has made a major de-rating on a lot of these palm oil stocks. The rebound in Wilmar we've seen recently is because they're going to do an IPO for their, I think the Indian Sugar Adani. So yeah, but there's a briefing next week, so maybe we can try and fill everyone up. But apart from that, really don't have any strong views. So sorry for that, can't really help you on it. Terence, you want to answer the SIA, is it? Okay.
No, sorry, I pressed wrongly. Sorry.
Oh, okay. Let me just run through what do you think of the DBS results. So just looking at Glenn's numbers. So Glenn, in his report, I mean, before the results were out, he was expecting 1.4 billion in PATMI, and more or less hit, because actually it was hit on the dot because DBS results was 1.38. But the DBS earnings was up almost 40%, and that's mainly because they reverse they reverse the bad debt provisions. So most of the growth came from that. If you look at if you want to look at the clean number for banks, we always look at the pre-provision profit before allowances. So that was down about 4%, and that's mainly because of trading income. So in a way, the banks are earnings, the core earnings is probably low single digit. And the only hope is that you get the NIMs coming in when the interest rate cycle. But the problem is, I don't think, like we said, the interest rates already still low. So you won't see the impact. I worry is that you won't see the impact of the higher margins probably only on the second or third quarter. So in the meantime, the earnings may not be that robust, because for DBS, they already kind of wrote back a lot of the provisioning. So we think the other two banks might have a better earnings momentum compared to DBS. Because DBS, their provisioning went negative, so they didn't have to provide. I mean, they wrote back a lot, whereas the other two banks haven't returned back. So maybe the other two banks, we think comparatively might have a better upside. I mean, this is just my view. I mean, Glenn would probably have a better. But in general, the DBS results was basically in line. The positive surprise was probably they upped their dividends higher than expected. We were looking at $1.17. They paid like $1.20. Okay, let me, SIA I really can't say. I mean, really, they're releasing the results also on Wednesday, but I don't think SIA is about results. Or SIA is all about news flow. So you're just purely riding on the news flow. The market cap, like we mentioned, is actually higher than pre-pandemic. But again, you're just playing on the news flow. So if there's aggressive reopening of borders, then this stock will just move. Yeah. Sorry, we don't really, not much I can add there for you. Yeah. Any thoughts on the Russia-Ukraine conflict as impact on equities? I think this one, again, this one, at most we can say is just going to be very, very negative, which is not much of a value add for anyone. Our base case is, our base guess, I guess, is that he may not actually do it because he's already getting a lot of concessions by just standing still. But it's such a waste. I mean, Russia got such a huge gas reserve, but instead they spend their time doing all this weird stuff, putting soldiers, parking soldiers near Ukraine. I mean, can have done more with their gas resource. But anyway, it will definitely be a negative, and it will cause a big spike in oil price and gas because all we know, because they're the second largest oil producer, and also they're the largest producer of gas for Europe. So any conflict will just send the energy prices skywards. But hopefully it won't happen. I mean, logically, he's getting already all the concessions by just parking troops. But again, this is more like a wild guess than an answer for you. This is interesting. Any listed companies that may benefit from the coming GST hikes? I guess most will get hit, but still interested to hear your views. We don't think so. I mean, most of the GST is passed through. It's just that I collect GST from the customer, then I would just offset it against what GST I paid. So most of it is virtually passed through. But there isn't any, we don't think of any. And even if you do a 1%, probably just a timing of purchases will be affected. Maybe a lot of people go and rush and buy Sheng Siong, then tomorrow buy them again, they come back. And so it's more of a timing issue, but I don't think anyone will benefit. Yeah. I'm sorry, I'm not an expert method a lot of this, but let me just try. What's your opinion on service price increase on Comfort impact? It will be a positive for Comfort because taxi charges are up after 11 years. It also shows that the authorities are willing to raise it. Because it will only benefit the taxi drivers, and it wouldn't directly benefit Comfort because Comfort is just collecting rental, but it will just makes the taxi drivers' takings better and of course stickier for Comfort. So it's more of an indirect, but it's definitely more positive. Yeah, very hard to put a number to it because it's all about the taxi takings, and most important is they reduce the rebate. Last year the earning was very bad because they gave like almost, depending on the quarter, 50% to 25% taxi rebates. So if taxi takings are up, they will not give any more of these rebates. Can you comment on Nanofilm earnings? Yeah, Nanofilm, I think we don't cover, but I think a lot of the analysts downgraded because they kind of guided that their expenses will be higher than expected. This stock is a bit difficult. Even though they got Apple and their earnings should be very strong, they are developing some new products. So unless you have a strong view that these new products will take off with new customers, or it's very tough, very difficult for us to, we don't have that strong view. So very hard for us to give any conclusive remarks. So sorry for that, because their product is a nano coating. That means in a vacuum changer, it's like vapor disposition kind of thing, like vapor coating, like very molecule kind of coating of components. I hope I'm not butchering their technology, but so what they're doing is looking for new customers, and that makes it very hard. It's not like if you have applied materials do well for UMS, we can give you better clarity. But this one is a bit binary. You're not sure whether they can find new customers, so we're not very clear on that. Yeah. Can investors get back their next question? Can investors get back their fund for SPAC at $5 from the issuer within 2 years? Yeah. The maximum is 2 years. Logically, most of these sponsors would want to do the de-SPAC, which is acquiring a company with less than 2 years. They're not going to wait until the last, because then they will not get their sponsor free shares. So most likely it would be within 1.5 years. they will make a de-spec offer. That means, shareholders, do you want to acquire this groovy technology company? and then everybody can vote. So you can actually vote, oh yes, I want, but give me back my money. So it's a big kind of a very unusual thing where people can vote yes, but then they get the money. So the issue is whether the spec at the end can even have enough money there to buy the purchase, although they agreed. But for us as shareholders, we don't care. We just say we just want our money back. We voted for it, but we just want our money back. Yeah. So you definitely get it. A maximum. Yeah, maximum is 2 years. Yeah. I hope that helps. The next one is a REIT. So Nettie, can you help out?
Hi. Okay. So the question is, please comment on Singapore REITs in a rising interest rate. Please comment on Singapore REITs on rising interest rates. Which REITs are undervalued now? So actually, based on our forecast, our target prices, most of the REITs are we actually have a accumulate/buy call on most of the REITs under our coverage. That being said, I think the most investors would be curious to know what would be the DPU impact for the REITs. So in terms of based on a 100 basis points increase in interest rates, and given the hedge ratio of most of the REITs under our coverage being about 70% and above, so we're actually looking at DPU impact of between about 1% to 5% DPU impact. Okay, so apart from that, I think as you know, a lot of the REITs, they're actually they've been very active on the acquisition or the AEI front. So that, of course, will also help with helping the earnings to recover. Yeah. And 2022 interest rates are expected to increase, but I think the biggest step up might actually come in 2023. Yeah. So even as we are approaching the rising interest rate, the period of rising interest rate, I think we might still be able to see some of the REITs push through a couple more acquisitions. Yeah. Okay, so in terms of our top picks for the sector, they would be Fraser Centrepoint Trust, as well as also Ascendas. Yeah. I'll pass the time back to Paul.
There's one more question on Digital Core. I'm not sure if you can help out.
The question is, can you comment on Digital Core? So for Digital Core, yes, they are pure play data center REIT. Most of their leases, unlike Capital DC, they are mostly on the core, shell and core, or a double net lease. So meaning to say that they have very high margins. And when you compare it to co-location kind of leases, co-locations are the ones that actually can charge a higher revenue, because there's actually some service charge and management, facilities management that is being passed through to the tenant. Yeah. In terms of Digital Core, I think one thing that strongly stood out is that they actually do plan to acquire from the sponsors pipeline, and they have a very sizable pipeline. I think it's about almost 2 billion worth of assets for them to acquire. Yeah, and most of these assets are located in the more western / developed kind of areas, and with their gearing, which was intentionally kept low at time of IPO, about 27%. This was actually meant for them to actually demonstrate that they can and will acquire from the sponsors pipeline. Yeah. That's about all I have for Digital Core.
Yeah, but anyway, we'll try to get them to do a webinar with us. Hopefully, yeah, they will agree. Then if you can help them, okay. Yeah. Terence and Jonathan, you want to help on the next few? Or?
I can go ahead first.
So I'll take this question on PayPal. PayPal price has been declining continuously. Is there a reason for the decline other than rate hikes and the upside? So we don't actually cover PayPal, but I'll try my best here. PayPal, after they released their earnings, they actually missed, their earnings actually missed in terms of comparing to what was expected by the street. So that kind of saw a steep decline towards the end of January. But overall, since July last year, has been falling about 60+%, or rather it has fallen about 60+%. But the good news, or the more positive news, is that one of the reasons why, obviously, as a growth stock, once you miss your earnings expectations, you just get pummeled relentlessly. But one of the good things is that over the course of the fourth quarter and last year, there were more new positions opened. So there are about net 4.5 million shares added, or rather bought by investors compared to those that sold. At the same time, after earnings, there was a significant influx in buying from their own companies, directors, and even the CEO started buying quite a number of shares. And this was because I guess the company management itself is quite bullish on what they're trying to achieve moving forward. One of the reasons why their earnings outlook missed was because the cost for acquiring new customers started outweighing what these customers were producing in terms of dollar value. And so the companies actually, or rather they mentioned they were going to start relooking and implementing a new strategy, especially as growth slows down, so they don't have to spend so much money on acquiring, but more on maintaining and managing their current accounts. So I guess it's also back to its pre-pandemic levels. So the base is kind of there, for the resistance is there. So they could provide some upside to buying PayPal if you're interested. I think that's all for me. Thank you. Terence?
Sorry, let me follow up on another question for Digital Core. So the attendee would like to know what is the expected yield of Digital Core. So based on the prospectus, there's actually a forecasted, the management actually did provide a forecasted DPU yield, or rather DPU in cents. So for FY22 and 23, forecasted DPU is 4.18 cents and 4.4 cents. 4.40 cents. So that actually translates to, given the current share price of $1.14, that will actually translate to DPU of 3.7 and 3.9. Yep. I'll pass back to Paul.
Mapletree Industrial Trust, you can help out, or Natalie, not sure. Okay. Now you go on to Terence's. Yeah, no problem.
Okay, sure, Paul. I'll probably take the rest of the questions in the queue also. That are for me. Any target price for Keppel Corp in 2022? Yeah, so our target price for Keppel is still $7.07. We didn't make any changes to the earnings. Our target price is derived from summing all the different parts of their report, all the different parts of their businesses together. And then we apply a 20% conglomerate discount to arrive at 707. So no change based on the latest developments to the group. But if you want more details, we can let me know. I'll send the report. I think the next question, Terence, this is a follow-up question. So Terence, shouldn't Hong Leong Asia could be a beneficiary from BRC Asia good results, as it has a stake in BRC Asia? Can it be said that there are no competitors here to BRC Asia? So I'll take the first question first. Yes, but there are Hong Leong. So some background. Hong Leong Asia have a 20%. They recently took a 20% stake in BRC Asia. So, but because of the size of Hong Leong, the full year contribution of BRC's results is less than 5% of Hong Leong's net profit. So there will be some spill through, but it's very small. Too small to say that it will benefit. But yeah, you could say that. But it's at this moment, at least the profit contribution is a little bit small. I think the second question, now, are there any no competitors? No, BRC Asia has competitors. One of their closest competitors to BRC Asia is NetSteel. So BRC Asia, their market share is fluctuates quarter on quarter and yearly, but they have about 65% market share in the space. So that makes them a dominant market leader in the not dominant, sorry, like a market leader in the steel reinforcement space, and also a proxy to the construction recovery. But there is competition. Yeah. Let me see. There's one last question. Does the target price for Keppel Corp include SPH and Sam Marine? No, so it does not. We have not included SPH, the potential acquisition of SPH in our model for SPH, because they haven't acquired yet, so it doesn't make sense to put the financials in. And then we also, for the second part, we also don't know what kind of deal structure Sam Marine will come back for Keppel Corp. So we haven't incorporated any of this into our model. Yeah. Maybe I hand back to the rest of my colleagues.
Oh, okay, thanks, Terence. Let me just try to and finish off the rest if I can. Vertex specs, any development explaining the fluctuation? I'm not sure. Maybe, you know, like in the US, whenever there's rumor of a spec acquisition, the share price tends to run because it's all spec, right? It's all speculative. Sorry, I'm just kidding. The share price tends to run when there's some news of a de-spec event. Market tends to get excited. Of course, the difference right now is that with the sell down in Nasdaq, profitless kind of technology stocks may not run so well with investors. So you have to be a bit more careful. Whereas in the past, now you can acquire a profitless kind of technology and just promise a lot of things, and then the people will say accept it. So I think now the sentiment is different. So it might be a bit more tougher to push through acquisition. It's quite self-evident, but just to reinstate it. But I didn't really hear. The only one I ever heard of anyone is maybe the One Championship, but I'm not sure which spec is doing it. But yeah, I'm not sure. Any update on the privatization? Sorry, we don't follow Razer. That's probably going to be done by our side. So sorry, I can't really help you on that. How much of the impact of Russian invasion of Ukraine on markets, is it worse than rate hike and inflation? Yeah, it has nuclear weapons, right? So it can be worse than a rate hike and inflation because you do not know what is the permutations. Assuming there is a invasion, then you're not sure what's the sequencing of events. Then what's going to do, what's France going to do, what's China going to do. So of course, yeah. Then the market will definitely plunge because you're not even sure what will be what. There could be really, although it's a black risk thing, but you can never know how things could unfold. So that would be definitely worse than a rate hike and inflation. Sorry, I hope that answers it. Yang Zhejiang upside recently, any color on that? Okay, so Yang Zhejiang, for those who don't know, so there are actually two businesses there. There's shipbuilding, they build containers, which done very well because the yards are all filled, can't get enough containers. And they also have, I call it their money lending hedge fund, money lending because they lend money and also invest in private equity. So hedge fund money lending inside Yang. So this split we think is good because then it might actually add more value because a lot of investors don't want to buy the container because I don't want to buy a hedge fund, right? A Chinese hedge fund inside a container business and vice versa. So by splitting up, you might be actually getting more value. So for me personally, the business if they show. So by splitting up, you might actually, the sum of parts might actually be better. Because in the past, some investors may not want to have a combo, this type of weird combo. So with splitting up, it might actually realize more value. So that's my own view, although we don't really cover, but I listen to their briefings for, I don't know, more than 10 years. Any update on Hong Leong Asia? I think this Terence has updated. Are US markets likely to remain depressed for the next 2 years? Okay, in our scenario, this 1-2 months will be very, if inflation that we mentioned earlier, the US started to spike from maybe March. So right now, it leaves February and even March quite vulnerable, because when we do inflation, when we normally do year on year, so the base year will become numbers are still going to be really high, because even in a year ago in February, the inflation was only like 1 point something. Then it only started to move in March and April. So we're just hoping that the year-on-year comparison will be weaker. Then the market will try to price in, okay, there will be rate hikes, but it will not be so steep because inflation is starting to come up. So that could be one possible scenario. I think that's what we are thinking of. Hopefully, I mean, if March, April is still like 8%, then we are in trouble. Then the Fed will probably have to move in every meeting, maybe 7, 8 rate hikes. 7 hikes this year. Yeah, hope that helps. Okay, I think the rest are all Natalie's. Yeah. Natalie, you can.
Sorry, I didn't realize that I did unmute. Okay, the question, sorry, earlier the question was, which would you prefer, Prime, Manulife, and Keppel Pacific Oak? So my answer would be Prime and Keppel Pacific Oak, and then followed by Manulife. Just purely because the Prime and Keppel Pacific Oak, these two counters, they have a greater exposure to what you will call the new economy kind of tenants. That means those that are in the life sciences, knowledge economies kind of tenants that are located within their buildings, and also the kind of markets that they're located in, which are experiencing, these kind of the demand from these kind of secular growth tenants, allowing them to actually increase their rents at a more favorable rate. Compared to the traditional kind of office using tenants, and then of course followed by Manulife, which they are trying to acquire more assets with these kind of tenants located in these kind of markets with these kind of tenants. So, but that's of course a work in progress. And then the next question is, any views on Mapletree Industrial Trust? There are various analysts targeting above $3 for target price, but the price is weak at $2.50. Yeah, so I think overall, since the start of the year, the REITs have been down a bit because of the interest rate headwinds. And more so because of the industrials, they have been more badly hit. I think also because it could be because of the rebalancing, where people are trying to go into the recovery place, and already the industrial REITs have actually recovered to pre-pandemic levels. Yeah, so I think they will hit on two fronts. And so for Mapletree Industrial Trust, in terms of their signing rents, from their results, their signing rents are actually relatively flat. Mostly flat. There have been some of the new leases were on higher rates, but largely their reversions for the Singapore portfolios been relatively flat. I think they are also still trying to fill up some of the vacant space in their data center portfolio. But of course, that just means that if they are able to fill it up, then there will be some kind of uplift. Yeah. Overall, their DPU growth was largely acquisition driven due to the acquisition of the data centers in 2021. Yeah. So we don't really cover Mapletree Industrial. We cover Ascendas. Yeah. So I won't comment too much about Mapletree, but just want to say that in comparison to Ascendas, I mentioned that their reversions are relatively flat. And that of course compares to Ascendas, which managed to deliver, I think, Singapore reversions about 3.8%, if I'm not wrong. Yeah. Oh, yeah. I think that's all for me. I'll hand the time back to Paul to conclude.
Yeah, yeah, sorry, the audio was a bit intermittent, but anyway, just to repeat, what we think is only when inflation tapers, we think then the market can really rally. I mean, without stating the obvious. And the two drivers will be the year-on-year comparison will be a bit easier, and also as the Omicron starts to fade, we hope that the supply chain bottlenecks can ease. So that we think could be the trigger for a rebound in the markets. Until then, it's almost open-ended how much inflation will rise or even the interest rate hikes. So with that, thanks everyone for your time and for all your questions. Yeah, we will try to get in the technical analysts to address a lot of your technical questions that you have in future. So thanks for your patience, and hope to see you all soon again next week, and Happy New Year and Happy Valentine's Day. Take care. Bye-bye.